All right, we're going to be going over a few examples of the main types of entries you're going to use. Um, and this video is going to be so the one thing that definitely tripped me up when I was learning ICT or when I was learning what I'm teaching you now is I would see all these models and I try to use every single one. Pro tip, do not do that. Use everyone at first, okay? And you're probably like, you just said not to use everyone. And then slowly after time you're going to realize which one you like better or which one you're going to be most comfortable with. Okay, and that's how you actually get good at trading, experimenting and seeing, like, if I take a bounce out of fair value gap, do I like this better or do I like breaker block better? You're not going to know what a breaker block is though yet. There's a bunch of different models. You're going to need to test a bunch out, and it's not going to be a 2-day thing where you're going to take one entry of each and be like, oh, I like this one better because it worked, maybe the other one failed. It's not how it's going to work. You're going to feel emotion, you're going to feel the different emotions in each setup. Okay, if you guys don't know, I take broken fair value gaps, and the reason I do that is because it's hard. Like when we really accelerate through a broken fair value gap, we really start accelerate, and it's less emotional on me, and I just prefer it more. Some people don't mind taking fair value gaps normally, but when you dance around in the same spot for 50 minutes, people really get psychologically what am I trying to say? Psychologically just hurt, and it's just you're going to have a different entry that you like, and other people are going to have another entry they like. Okay. So the basic pattern, which I'm saying pattern because you're going to see it as a pattern at first. Okay. We're going to enter off of is when we take some sort of stop loss. Okay. So I'm just going to draw a horizontal line right here. We're going to say there's a bunch of stops resting below here because it's support, and people are going to have a bunch of orders sitting down here, stop losses. So the one thing you guys need to know is if we form a fair value gap here, okay, do not long this. We have not ran any stop losses. It does not make sense long. If it works long and we pump 300 points out of it, and you go back to this video and you're like, but he said it won't work. It's not going to work more than 30% of the time. It will work occasionally, but just trust me on this. Not a good fair value gap to take. We want to see price really rally through some sort of liquidity first, and then we look for an entry. Okay, and the basic entry is always going to be a run of liquidity or some sort of buy side. And let me just give you a few examples. This is going to be hive day, okay, low of day, high of week, low of week, London low. The possibilities are endless. The number one thing people ask me when it comes to running some sort of liquidity level, okay, the number one thing someone asks me is, how do you know which one to take the setup off of? Sometimes you don't. There was an instance in my last Friday's live stream where what happened was I was actually kind of bearish, and unfortunately we held this gap right here. So you can see this is a fair value gap. You can see based off what I've taught, okay, it is the first candle here and the third candle here do not overlap, making this a fair value gap. And I was kind of bearish, and what happened was I really switched my bias off of this candle right here because I saw how much we held it. I saw that we kind of violated or broke this little tiny bearish fair value gap right here. And you don't know, sometimes you will not know the bias until you see something that tells you the bias. Just like being, sometimes you don't know if we're going to run London high or London low and get a reversal until you see it. A lot of things I notice is this. So someone will go into the trading day, they'll have their London high marked out, okay? And let's say this is London high, okay, which I still have to go over the kill zones. So I'm getting a little ahead of myself right now. But this is London high. This is just an overnight session from 2 to 5 a.m., really, where people draw the London high. But you'll learn that in the kill zones. And let's say there's a previous high day right here. Okay. So let's say there's high day right here. And let's say there's some sort of equal lows or something beneath. Okay, let's say there's really obvious equal lows here. Okay. So we kind of have this little setup, this fake scenario. We have a lot of equal lows on here, a lot of stop losses resting below here. And people ask me, how do you know which one we're going to reverse at? Or how do you know where we're going to get the entry model? Are we going to get the entry model here? Or are we going to get the entry model here? And sometimes you do not know. What you're ideally looking for is you're looking for a short setup over any of these. Okay. So what I mean is you really want to see, like, if we get this, okay, like a market structure shift or something with a fair value gap here, and we only hit London high, that is price telling us, okay, we have a high day here that wasn't hit, but we also hit London high, and we have bearish displacement below low. Does it make sense for price to rally down from here, knowing that we did take out some sort of liquidity, but maybe not all liquidity, especially with equal lows below? And the answer to that is yes. So we could get this here, or we could get it here, and until you see something that looks like this, okay, you don't exactly know where we're going to reverse. Now, there's going to be more advanced things that may tell you, such as a fair value gap to the left here, or maybe a fair value gap to the left here. Okay, but you will learn that through screen time, and it may be more probable to go up to like a high day if there's a fair value gap from a few days ago sitting to the left right here, if that makes sense. Okay, but let's say there's no fair value gap over any of these. Sometimes you're just going to have to wait for the market structure shift at one of these levels, whether it be London high or high of day. Remember, if we don't really get a good market structure shift at London high, right, if we don't really shift structure there, then chances are we're probably going to keep running higher at a higher day, a high of day. And that's why market structure shifts is important, because if you pair market structure along with liquidity, like, you're going to know, okay, we hit this level and we got a market structure shift. Here's my chance to get in. We're probably not going to go higher here, as long as it's some sort of decent liquidity. And you're going to learn that like a London high would be good enough to liquidity, especially if there's equal lows below. Okay. Now, there's a lot more stuff you can add into this, which I'll be going over in later videos, such as maybe an SMT. Like I said, a fair value up to the left, maybe rejecting an order block. Okay, there's a couple more things, but you'll learn that through screen time, as I said, and I still have to go over some of those in future videos. So that's like the biggest misconception. A lot of people think, oh, we need to hit high day and London high to go down. But if we do get a market structure shift, then we only hit London high and we have good enough. And keep in mind, the key is here. The key here is we have good enough liquidity below. If we don't really have good liquidity below, then obviously it might not be as probable to hit London high and go down. It might be more probable to hit high day, especially if we lack a lot of stop loss orders or what looks like could be stop loss orders down here. Okay, now that's like the biggest misconception I've seen, especially when it comes to looking for an entry, and that's definitely something you'll learn through screen time, like I said, and that's all I got to say about that. Okay, so let's say the main entry model is going to be something like this. We have liquidity below, equal lows, and we have a fair value gap retracement right here. Okay, this is going to be the main entry model. Whether we hit London high or high day or not, as long as we get something that looks like this with good enough liquidity below, like I said, that could be an entry. So let me see if I can find an example on the chart. So like right here. So we take out a bunch of highs here that were equal highs. We also were at high day. So keep in mind, this is a session of the day. Okay, this was from the previous day. Okay, so this is the previous day. It looks like previous day high was right here. So this was kind of high of day, right? And you see this is high of day. And some people might think, well, okay, we have liquidity at high of day, I meant the high of the previous day. Okay. So we have liquidity at the high of the previous day, but we've also taken out that high of day liquidity right here, where we kind of created a high of day and we kept creating a new high of day, and we obviously hit it. And even though we didn't go to a high of previous day, we got something that really looks like a lot of displacement down with a fair value gap. So you're probably wondering, like, would I short this? And the answer is yes. Even though we didn't have a high previous day, you can see this reaction right here is pretty violent, in my opinion. Pretty violent reaction. There's kind of a couple things you should note here. One thing you should note is if the bias is bullish, we probably would have bounced off of this and went higher. But you can kind of see the candle cuts through it. You can see we kind of create this fair value gap up here, which wasn't quite tapped into. And you can kind of see this fair value gap here, which it's okay if we go over a fair value gap and reject it because theoretically your stop should be at the high. Now, if we go to the 2 minute, it was also a 2 minute gap. If we go to the 3 minute, it was also a 3 minute gap right here. In the 3 minute gap, the bodies did hold. And remember what I said to you at the beginning of the bootcamp. Bodies are one of the most important things you will ever need to know. See how we kind of wick above, but the body of the candle right here, or the close of the candle kind of holds this fair value gap. That is a very important sign. And you're probably like, well, you're doing this multi-time frame. You just went from the 1 to 2 and see that the 1 and 2 didn't hold, and now the 3 hold. That's hindsight. The more you trade, the more you're gonna have to juggle between these couple time frames and get a sense of, okay, where's the most obvious gap? And to be honest, the most obvious gap to me definitely looks like the 3 minute. I mean, it's singular. There's not like 50 million fair value gaps in the leg, so obviously some times we're gonna have like 3 fair value gaps in the leg, and it's just not clean. This to me on the 3 minute is the cleanest gap I've seen here. Okay, if I go to the 2 minute, I mean, you got 2 of them. You got this one and this one. All right, and if I go to the 1 minute, you got this one way up here and then this one right here. So it's definitely the most clean on the 3 minute, as you can tell. And you need to be juggling through all these time frames because this is really going to be like, okay, this is definitely bearish. Like the bodies are respecting this, whatever, and that's that. Okay. So this is just an example where we don't quite hit the high of previous day, but we get price action telling us, okay, we get price action telling us that we are bearish here. Now, remember what I said. What if this candle didn't exist? What if it just looked like this? What I really think we're going to reverse here, not unless I had some ultra, like, I don't even know, ultra hindsight time matches price, little tiny fair value gap, whatever the hindsight you want to call it. But do I really know we're going to reverse there? No, not truly. Now, you're going to see a lot of people on Twitter be like, oh, I shorted high day. I knew we were going to reverse here. And yeah, they do. But they also win 50% of the time and lose 50% of trades. They don't know that every time. Something that's going to increase your win rate very high and make it very high is not trying to guess where the top's going to be and waiting for price to tell us, okay, here's very bearish price action. Here's where we kind of got a structure shift or whatever. And then that's going to be a more high confidence short. So the number one thing people don't understand is I don't know this is going to be Hive Day or the new Hive Day. All I've seen is we keep taking a Hive Day and there's just no price action that really tells me we're going to reverse until we kind of get this, okay, which is right here. Now, a different example right here would be here. Now, you're probably wondering, why wasn't this a market structure shift here? Well, the problem with this is we bounced off, like we were holding another fair value gap here. Okay, so there's kind of a mix-up of time frames here, and this is where it gets really complicated, and I'm sorry for losing some of you. This is where it's going to, I think the best of the best, especially after this point, are going to be the ones that make it. Not the best of the best, but the people who can replay this and kind of understand this a few times and understand that you need to check the 3. You have to check the 5. You can't just stay in a singular time frame. All right, like we were holding a very obvious, okay, I'm sure you would call this obvious. You can really see it like 10 feet away from the screen. Very obvious gap here. So what does that make this 3 minute short? Not a good short because technically order flow, okay, we call this order flow, is still bullish, okay? You don't need to see a DOM to know order flow is bullish here. It's just, you just know it's bullish based off the trend, based off of how the fair value gaps are holding, etc. Okay, so the first kind of entry model is going to look something like this. And like I said, Sometimes you get it in London high, sometimes you get a high day, sometimes you can get it at Asia high, sometimes you could get it at random equal highs, whatever. But it all goes hand in hand with, you have to understand that you might not know where we're going to get it until we kind of get kind of what looks like this model. And now there's things you could add to this model to make it more high probability, which I'll go over in obviously later videos. But to be very basic, this is the idea of what you're kind of looking for. So this is going to be your main entry model. We're just going to go over a couple more examples. Okay, so a couple more examples would be something like this. So in this example, we have a low here. It's very obvious. And you can see this big wick takes out this low here. So I would consider stop losses ran. I would consider people trying to short this breakout or short this support. Okay, I would consider them stopped out, wrecked, whatever you want to call it. And I would consider there to be enough liquidity to allow bigger money to get into a long position here. So now where do we look for an entry? Well, we have to look for something along the lines of this. Okay, with a market structure shift here, some sort of fair value gap here, and this is where we get in after liquidity has been swept. Notice how there's some sort of liquidity sweep here. Not every liquidity sweep is going to look the same. Like this one right here is just, it's very subtle. You might not see it, but it's there. Okay, it is swept. Now, where do you look for, like, now here's what you could simply do. I mean, if you go to line chart, you can see the market structure way better. So we got a dip here, high here. I guess I'd consider this a high, high, low. So we kind of got like a market structure that kind of looks like this, if I had to say so myself. So something like this. So that's kind of what we're working with for market structure. Now, what would be a good shift in structure? Well, displacement over the last lower high. And you can clearly see this is the last lower high, and this was the last higher low. And you're probably wondering, like, why wouldn't this be a structure shift to the downside? You're probably like, well, we're making lower lows here. Two things. We're making lower lows, but look at this displacement below this low. Would you consider this a lot of displacement? No, I really wouldn't. Okay. Versus, would you consider this a lot of displacement to the upside? Well, yeah, I would, because just look at how much more we go over this high without going under this low that much. So that's the first thing. The second thing is, remember what I said. It all comes down to liquidity, not market structure shift, or not market structure, not fair value gaps, not whatever else you want to use. It's all about liquidity. Think about it. If we've already ran stop losses here, why would you be looking for a market structure shift to the downside if we've already ran stop losses once? You wouldn't. And for the 30% of the time that this does go down here, that means one of two things. That probably means it's just a typical rare occurrence in the market, which doesn't happen a lot. Or two, there's probably liquidity, maybe equal lows or something lower. Okay, there could be equal lows down here. Obviously, in this example, there's not equal lows down here, as we can see, obviously. But that's usually what that means. So this entry model here, you'd be looking for a shift, and you can see we clearly get that shift right over this high. Now, how do you know that this is going to be a shift in life? Like, when do I really know when this is going to be a good shift? Not here, because we really haven't displaced that much above it. Not here, to be honest. Okay, now here, this is definitely where I'm like, okay, this is pretty good displacement. Now I think it's going to be the market structure shift. I understand we swept sell side. Look for the fair value gap now. I'm not looking, it's not like I'm looking for the fair value gap first. Now, they do go hand in hand, I would say so, because if there was no fair value gap here, honestly, it would not be a good long setup. But because of the fair value gap forms here, then yes, it was going to be a good setup. So where do I look to take the entry? Inside this fair value gap. Because we have a market structure shift. We understand we swept liquidity on the higher time frame. Okay, and like you can see it in the 3-minute, you can see it in the 5-minute, you can see it in the 15-minute. You can see this liquidity sweep in a lot of different time frames. You can even see it on the hourly time frame. Okay, and by the way, something really cool is look at this. There's actually equal lows here, and we swept equal lows. Half of you probably didn't know that. Okay, so you can see this liquidity sweep on almost every time frame here. We have a very obvious market structure shift on the 3-minute. We form a fair value gap, and that's when you look for your entry. Now, you might notice you're like, well, Ryan, we didn't get the entry. No, we didn't. You're right. Would it have been a good entry if we got it? Most likely, yes, but we didn't get it. Now, this is where trading and having a plan and everything comes in place. The more advanced you get, the more opportunities you're going to see. Because here's the thing. Yes, we didn't get the 3-minute entry, and some people won't want to go below the 3-minute. Some people won't want to go below the 5-minute, and that's okay. We just don't happen to get a 5-minute entry right here. But you got to realize, like, if you understand liquidity well enough, and you understand we did sweep the sell side, we did sweep this low, and you understand that, okay, there's barely any displacement here. We're holding another bullish fair value to the left, whatever it may be. If you understand liquidity well enough, do you really need to know, like, okay, we need a big shift here. We need a market structure shift here for me to long this fair value gap? You don't, because here's the thing. When you think about it from a liquidity standpoint, okay, you know stop losses have been ran here. What is the point of coming back down here, especially after this kind of displacement, when you know stop losses have already been ran? There's no point. So can you go to the 1-minute and take an entry right here, even though theoretically there wouldn't be very big displacement above this yet? Yes, you can. And what I mean by that is, like, when we get this entry live time, theoretically, like, there's not really that much displacement this high yet. But can you still long that fair value gap, knowing from a liquidity standpoint that that's going to be a good entry? Yes, you can, because of where liquidity is, how liquidity works, and we've already ran stop losses. We don't need to run them again. So that is kind of what I'm trying to gear you guys towards. Okay, that is being a real trader and understanding from a liquidity standpoint that would be a good entry that works. We got a lot of displacement. And sometimes we honestly don't need displacement over the last high. I mean, these 3 candles are really, like, if you think about it from common sense, these 3 candles are obviously enough. Okay, like, this is enough for me. It's just, think about it. What's going to create a candle like this versus what's going to create a candle like this? Let me show you. So what's going to create this candle and what's going to create this candle right here? A big fund, institution, bank, whatever algorithms have running are going to create this candle. So this is probably a very bullish candle. Retail, smaller money is going to make a candle like this. It's not as telling. It's not going to help you as much. There's no guarantee we go up or down after a candle like this. So if you take that logic into trading, just to me, these 3 candles, even though we really didn't displace above the high that much, would be very telling to me that, okay, this fair value gap is probably going to work from, okay, I see these 3 candles, and I also see we swept liquidity here. So that is like the main entry model you guys are going to want to learn and just watch play out a lot. Okay, so from the bearish side, it looks something like this. From the bullish side, it looks something like from this. And it's always going to be a different liquidity point every day. There's going to be equal highs. There's going to be low day. There's going to be a weekly low. And that's just how it's going to be. The other misconception I see a lot of people kind of look for is this might be low day, and they might miss, like, they might miss equal lows below here. And we will get the entry. Like, they might miss equal lows here, and they just might not see that. And that's okay. Like some people don't go far back enough to see this. And this entry is going to fail. Okay, we're going to just go straight down here, and that entry, this is going to fail. Okay, so I'm going to draw a little X through that. So, and they're going to be like, well, what dodge you taught me is wrong, or what ICT you taught me is wrong. It's not wrong. It's just the fact that you weren't aware that there's more liquidity here that needs to be ran. Okay, and some people aren't going to be able to truly master and know every single liquidity point for a while. And don't get me wrong, these entries, even if we do have equal lows here, will work occasionally. But if you want the highest probability of any reversal model, almost every single liquidity should be run. And you're going to get a gauge of what I mean by that, like after you watch this whole boot camp and after you trade for a year. You're going to come back to this in a year. Half of you probably not going to even credit me for, and you don't need to credit me if you don't want to. I don't want to be called master or anything. Half of you guys are not even going to remember watching this boot camp, but little do you know, it actually did contribute a lot to your screen time, and there's going to be something that you're using a year from now that you're going to be like, oh, I remember that from Dodgy's boot camp. He kind of said the same thing. And some of you are like, well, I've seen this myself. It wasn't Dodgy teaching me this. Dodgy showed me it, but he didn't teach how it works. I learned after watching the chart how it worked, not Dodgy just saying it. And it kind of goes along with me learning from ICT. I learned some of this stuff after ICT showed me it, but then I kind of use it my own way and be like, oh, I get it now. And that's going to happen to some of you in a year from now, if you even make it that far. Half of you won't. All right. And that's just how it's going to work. All right. So all in all, I think the biggest thing you should take away from this video is there's going to be entries that look like they shouldn't work based off what I teach. And yeah, they normally won't, but they're going to work sometimes. Like there's going to be entries that we maybe have equal lows below or something, but you're still going to see like a bullish for value gap work or something. And that's completely fine. But you're going to learn the more you trade. And this is, again, through screen time. The more you trade, the more you are going to see something like this fail. And it will work sometimes. But the more you trade, the less you're going to get FOMO into seeing this work because you know how low probability something like this is. So this is just like the basic 2022 ICT model I just taught you. And the other thing I want to say is this. The best fair value gaps are always going to have the best displacement, meaning a fair value gap with displacement below low like this is not going to be as good. Okay, like you can clearly see this one here, we don't really have much displacement below low. So is this one going to be really good? No, it's not. But if you have strong enough conviction and there is very obvious equal lows down here, then this would be a setup that through screen time, you maybe be like, okay, we do have equal lows here. I know this isn't big displacement, but I know there's a bunch of stop losses down here. Maybe I will take this. And you're going to notice these little things that you're going to accrue through screen time, such as something like that, and be like, okay, do I really need displacement here, or do I have enough conviction in these equal lows? So that's going to be something you're going to have to figure out years down the road, 1 to 2 years. It's going to take you to figure out like whether you want to take this up or not. And it's definitely going to come along with knowing some other things I haven't taught yet. And don't worry, you'll learn. Okay, you'll learn, and you need screen time, but this boot camp is going to be the start for you to learn this. Okay, so this is going to be it for this video. I'll see you guys in the next one. Peace.